What if a single portfolio could generate growing income for the next 20 years? Without requiring stock picking, earnings calls, or constant portfolio management? Most investors focus on chasing the highest dividend yield available. But historically, the investors who built substantial wealth often focused on something very different: dividend growth. A company paying a 2% yield today that increases its dividend by 10% annually can become dramatically more valuable than a company paying 6% today with no growth. This is the hidden power behind compounding. Now imagine applying that principle not to individual stocks, but to an entire portfolio of elite dividend ETFs. In this video, I will break down a hypothetical $500,000 dividend growth investing portfolio designed around quality, free cash flow generation, sustainable payout ratios, and long-term passive income expansion. We'll analyze the ETFs, examine the income projections, discuss the risks, and show how this portfolio could potentially evolve over the next decade. The portfolio allocation is intentionally simple: 40% allocated to SCHD, 25% allocated to VIG, 20% allocated to DGRO, 15% allocated to VYM. The objective is straightforward: create exposure to dividend aristocrats, dividend kings, high-quality dividend growers, and broad dividend-paying corporations, while maintaining low expense ratios and strong diversification. This structure balances three critical variables: current yield, dividend growth, portfolio quality. Instead of concentrating capital into a handful of individual companies, this framework distributes risk across hundreds of businesses with established dividend cultures. The result is a passive income stream supported by some of the strongest balance sheets in corporate America. The largest position is SCHD. The Schwab U.S. Dividend Equity ETF has become one of the most respected dividend growth funds in the market. Its strategy focuses on companies with strong balance sheets, healthy free cash flow, sustainable dividends, and attractive valuations. Current yield remains near the mid-3% range while maintaining a long-term dividend growth rate around 10% annually. Its expense ratio remains exceptionally low at just 0.06%. This ETF provides exposure to businesses that combine income generation with capital appreciation potential. Rather than simply chasing yield, SCHD prioritizes dividend sustainability. That distinction matters enormously over multi-decade investing horizons. The next two positions focus heavily on dividend growth. VIG tracks companies with at least 10 consecutive years of dividend increases. It intentionally excludes many high-yield names and instead emphasizes quality and consistency. Its yield typically remains around the high 1% range. DGRO takes a slightly different approach. The ETF requires at least 5 years of dividend growth while also screening for sustainable payout structures. Historical dividend growth has remained near double-digit levels, while maintaining moderate yields around 2%. Together, these ETFs provide exposure to companies whose dividends may grow substantially faster than inflation. This is where compounding becomes exceptionally powerful. A rising dividend stream creates an expanding passive income stream without requiring additional capital contributions. The final allocation belongs to VYM. Unlike SCHD, which focuses on a more concentrated portfolio, VYM owns hundreds of dividend-paying companies across the market. The yield generally falls near the 2 to 3% range while providing broader diversification than many dividend-focused alternatives. Its expense ratio remains extremely low, helping investors retain more of their investment returns over time. VYM serves as a stabilizing layer within the overall portfolio. It reduces concentration risk while maintaining meaningful exposure to dividend-paying blue-chip businesses. For long-term investors, diversification remains one of the simplest forms of risk management. Let's examine a hypothetical scenario. Assume the portfolio generates an average starting yield of approximately 3%. A $500,000 portfolio would initially produce roughly $15,000 annually in dividend income. Now assume dividend growth averages 7% per year. The compounding equation becomes remarkably powerful. After 10 years, the income stream could approach $30,000 annually. After 20 years, the income could potentially exceed $50,000 annually. And importantly, this growth would occur without requiring the investor to sell shares. This is the essence of dividend growth investing. Not simply collecting dividends today, but building a passive income stream capable of expanding for decades. No portfolio is risk-free. Dividend investors often underestimate several important dangers. The first is valuation risk. Even exceptional dividend ETFs can underperform if purchased during periods of excessive market optimism. The second is sector concentration. Many dividend strategies naturally tilt toward financials, healthcare, consumer staples, and energy. The third danger is the dividend trap. A high yield alone does not indicate quality. When payout ratios become unsustainable or free cash flow deteriorates, dividend cuts often follow. This is precisely why funds emphasizing dividend growth, profitability, and balance sheet strength tend to outperform pure yield-chasing strategies over long periods. The goal is not maximizing yield. The goal is maximizing sustainable compounding. Balance sheet strength metrics. A $500,000 dividend ETF portfolio is not designed to create overnight wealth. Its purpose is far more powerful: to build a growing passive income stream backed by high-quality businesses, low-cost ETF structures, and decades of compounding. SCHD provides income and quality. VIG provides elite dividend growth. DGRO balances growth and diversification. VYM expands market-wide dividend exposure. Together, they create a framework that prioritizes durability over excitement. Now, here's the question. If you were building a dividend portfolio today, would you prioritize higher yield or faster dividend growth? Let us know in the comments below. I'd be interested to see where you stand. This content is for educational and informational purposes only and should not be considered investment advice. Investing involves risk, including the possible loss of principal. Always conduct your own due diligence and consult a qualified financial professional before making investment decisions.